Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, the market, as you know, is off to a resounding start year to date, early in 2023, and particularly the equity markets, that is. Will the market continue to appreciate? We're going to dive a little bit into history today, and particularly how the market, specifically the Dow, has responded in the year following a high inflation report. So let's dive into some of the data that may give us an indication of what the future holds. The Dow's performance after high inflation. Now, you may recall last year that, of course, inflation was probably the biggest, or at least one of the biggest headlines of 2022. And of course, entering into 2023, it's still a topic of discussion because we're all likely feeling it. But the U.S. inflation rate in 2022 was officially 6.5%. That is high by historical standards. Now, as you know, if you were in the equity markets, the Dow, S&P, and the NASDAQ lost 9, 18, and over 30% respectively. So we can't change the past, but what we can use is some of the data from the past that may give us an indication what likely or potentially would happen in the future. Well, what is likely to happen to stocks after a high inflation year? Well, for maybe some clues, let's look at history. Now, again, this is the Dow Jones Industrial Average, which, as you likely know, is 30 stocks. So just keep that in mind. It's really comprised of 30 stocks. Well, inflation from the mid to late 70s was quite high. Again, 11.05% in 74. In 75, we creeped over 9%. And actually, last year in 2022 was, interestingly enough, the same inflation rate we saw in 77. Well, you could see the Dow's return the following year has historically been very good. And it's very rare to have two down years in a row. In fact, the last time that happened was the dot-com bust, where in 2001, 2002, we had 3 negative years. So odds favor we're not going to have a negative year for 2023. Again, if history is any guide, irrespective of the fact that we've gotten off to a great start this year. But the bottom line is the average return after inflation has seen a 6.5% number, or report, if you will, or above, again, after inflation has equaled or greater than 6.5%, the average return is 17.69% for the Dow. So that is quite encouraging. Yes, things have gotten off to a great start. Maybe we're a little ahead of ourselves, but that is encouraging news. So you may be wondering, okay, great. I have some cash to put to work. Is now a good time to invest? Well, one of the things that many money managers and portfolio managers look in terms of the greed or fear in the marketplace is something called sentiment, which, as you know, is how investors are feeling about the current market environment. Well, one of the media outlets has a fear and greed index, and right now it has a high/extreme grade reading. So extremely greedy in terms of where most people feel that the markets are going to be in 6 to 12 months. Now, this is comprised of a few metrics, so just keep that in mind. But what's important is how to interpret this information. Now, typically, the masses are wrong most of the time. So if the masses think, generally speaking, one thing's going to happen, the tendency is for actually the exact opposite to happen. So if overwhelmingly people are bullish, that's something that should be quite concerning. Or if you even look at last October, around October, November of 2022, folks were overly bearish. In fact, going back to this recent fear and greed index, look at 1 year ago on the bottom right here, fear was at a historic high. Look at even 1 month ago, the index was neutral, again at a 54, again now it's 77. So sentiment, again, how folks feel about an investment or the financial markets is one we would call a secondary indicator to give you an idea of whether it's a good time to invest or not. This is one of the tools that many money managers would use, again, to analyze whether there's a potential good time to invest or not. Our opinion is, just by reading this, yes, the market's off to a good start, and yes, there's some good economic data coming in, particularly, for example, with the unemployment rate being at about a 40-year low. But maybe now we want to be a little cautious if you have new money to put to work, simply because folks are being, at least per this indicator, a bit too optimistic. So perfect world, wait for the market to pull back, and if it has a reasonable pullback where it's constructive, meaning where we don't see a big sell-off, maybe you consider putting money to work. But all that to say is positive information, again, based on looking at the Dow Jones Industrial Average subsequent to a 6.5% or more / high inflation number. Things are, at least a study of history would show, things are potentially very positive, for 2023. So again, be patient. Certainly, if you would like a second opinion on your portfolio or financial situation, you can go on our website. This is what the front of our website looks like. Click on the Request an Appointment tab, and then fill out the information, and one of our advisors will reach out to you and answer your questions, and hopefully give you some clarity and peace of mind in today's very volatile, continuously changing market environment. Thanks again for watching. Bye-bye.